Welcome to Delphos Insights. This is episode 36, where we examine capital raising for agriculture projects and what investors require in 2026. Imagine you were trying to secure a massive commercial mortgage for, say, a skyscraper.
Right.
But instead of providing audited financial statements, you just hand the bank a handwritten note that says, trust me, the rent checks are coming.
Yeah, that definitely wouldn't fly with any institution.
No, not at all. But for decades, that was roughly how agricultural finance operated in emerging markets. Today, though, we are analyzing a fundamental shift across Latin America, Africa, and Southeast Asia. The era of self-reported operational data is, well, it's officially over.
It really is. I mean, institutional lenders, including development banks and DFIs, they have entirely changed their baseline. They now require independently verified production records before a transaction can even advance.
So no more taking the sponsor's word for it.
Exactly. They demand satellite-monitored NDVI verification and AI-driven yield forecasting. It is a mandatory requirement now.
Let us clarify what that actually means in practice. We are talking about using satellites to measure the precise greenness and health of crops from space.
Right. And the verifiable accuracy is unprecedented. AI prediction achieves 85 to 95% accuracy. In fact, the best models explain 92% of crop variation.
Wow. 92%?
Yeah. When you contrast that with traditional methods, which only sit at about 60 to 70%, the gap is immense. Lenders just will not anchor a financial model on yield data they cannot independently audit from space over at least 2 growing seasons.
Which directly impacts capital flows. So let us look at the numbers, because they reveal a fascinating divergence. Agri-food tech investment in developing markets reached $3.7 billion in 2024.
Which is a 63% surge.
Right, a massive surge, especially while global venture funding actually dropped 4%.
True, but if we look at the first quarter of 2026, agriculture was just 0.57% of global venture capital. 163 startups raised $1.89 billion, averaging $11.6 million per round.
Wait, I have to push back on that. The World Bank Group has committed $9 billion annually by 2030 to this space.
Yeah.
So if that massive pool of capital is waiting, are investors just avoiding the sector?
They are not avoiding agriculture at all. They are just rejecting unpreparedness.
Ah, I see.
If sponsors lack satellite-verified yield documentation, they are filtered out early. For context, only 14 of 91 IFC agribusiness projects recently deployed risk capital.
Only 14.
Yes, and the deal sizes averaged $57.6 million. The capital is absolutely there, but they will only fund what they can verify.
So how do agribusiness sponsors actually survive that institutional filter? What makes an investment memo actionable?
Well, there are 6 core diligence components. Obviously, you need the AI-verified production data we mentioned, but you also need a stress-tested financial model that maintains DSCR expectations, meaning debt service coverage ratio, even in downside scenarios.
Right, proving the project can survive a drought or a price crash.
Exactly. You also need strong offtake structures to mitigate revenue concentration risk.
So having guaranteed buyers locked in.
Right. Add to that a clear capital stack design and ESG governance that is fully aligned with IFC performance standards.
Let us talk about that capital stack design, specifically blended finance. How does preparation quality change the execution there?
It accelerates diligence speed and improves pricing. DFI-backed products, which account for 18.2% of funding, use blended finance structures to improve bankability.
Using instruments like first loss protection and AB loan structures, right?
Yes, those credit enhancements significantly reduce the risk for commercial banks.
And we have seen this work. There was $22 million for AgriCorp in Nicaragua, a $50 million regional Crescera facility, and $34 million for MPC Energy Solutions in Guatemala.
Exactly. When operators prepare properly, they secure financing while others are filtered out.
Which brings us to a strategic question for you to consider. Have your agriculture sponsors reached the documentation and governance threshold institutional capital providers now require before a transaction can advance to formal diligence?
That really is the defining test for sponsors today.
This has been Delphos Insights. Learn more at delphos.co.